We're now going to look at the cost of capital, and in particular WACC, W-A-C-C. So let's kind of get started here. This can be confusing, so just be very patient. What we're measuring is a firm's cost of capital, and we're going to calculate the after-tax cost of debt, preferred stock, and common equity. So, and then we're going to combine those per their percentage and come up with the weighted average cost of capital, WACC. And then we'll kind of use it to evaluate companies and what their cost is. And then you can also use it for new investment opportunities. So let's kind of get some key concepts here. So what is capital? Capital is going to be anything found on the right-hand side of that balance sheet. Liabilities and common equity. Long-term liabilities, and we're looking at the equity section. So the main sources of capital are debt, long-term, bonds, preferred stock, retained earnings, and common stock. What are these? These are resources that we use to fund the company, right? So it's important to know how much all of that costs by a percentage, so you need to know, so you know how much the cost is to fund new projects. And a lot of that is, we talk an awful lot about investors' required rate of return, because if they aren't getting the rate of return they want, they're not going to allow us to, i.e., borrow money, or they're not going to want to invest in us. So you really have to understand investors' rate of return versus cost of our borrowing or our capital. So there is the required rate of return, but then you have the cost of capital. And out of cost of capital, if we're paying interest, that is deducted from our income. So you have to take into consideration taxes. So that would lower. On the other side of it, you have to look at, usually there are transactions costs associated with stocks and bonds. Selling them, we have to pay a fee to have somebody do that for us. So that may affect what our cost of capital is also. So the impact of cost on capital, for example, okay, here's a good example. We sell a new stock for $50, but there's a $5 flotation cost or transaction fee, and we only receive $45. Now, the investors require a rate of return of 15%. So how much do we have to earn to get that 15%? Well, if you look at it, okay, we only receive $45 to work with here. So to figure out our true cost of capital, because we have to return that 15%, or the investor will go someplace else, we've got to look at this and say, okay, what does the investor want? So 15% times $50, they want $7.50 for each $50 investment. Okay, so $7.50, but I only have $45 to play with. So what percentage of $7.50 of that $45, what do I have to return on that? Well, if you divide that out, you'll find out instead of returning 15%, we've got to make 16.67. So this is the cost of capital. This is what the investor requires as a rate of return. Always keep that in mind. Those two are not the same. And then we're going to look at some financial policy and the mix that a company uses for financing their activities. It could be 60% stocks and 40% bonds. It could be flipped. And that's going to impact the cost of capital, which will impact projects down the road. So how do we determine cost for individual sources of capital? And This is a fairly good breakdown. It's very detailed and has a few more details in it than the activity we're going to be doing. But this is the overall very detailed breakdown of how to figure the cost of debt. We've got to play for flotation cost, right? So we've got a bond, and the bondholder has a rate of return they require. And usually that's dictated by the market. Even though we have the bond written at 8, the market may be demanding 9%. So we need to return what the market or the investor wants. So we also have to pay cost to get that bond out into the market. We'll have to pay a company to offer those, just like we pay a company to offer our stock. So you're usually going to have debt capital will be higher, okay? Our cost of debt will be higher than the bondholder's required rate. And here's an example, and I think examples work better than me talking about it. The investor wants a rate of return of 9%. But there's a flotation cost, okay? And before cost of capital, which means we had to pay somebody to write up those bonds and get them out on the market. So, and after all is said and done, there's a before tax cost of capital that we require. This is how much it's cost us, of 9.73%. So now we have to, now remember, we're paying interest, so that's going to lower the net income. So we're getting some of that interest cost back. So now we have to figure the after-tax cost of debt. And that's going to be the cost of debt, 9.73 times 1 minus the tax rate. And the tax rate is 34%. So the true cost of debt after tax is 6.422 rather than this 9% required return by the investor. So you can see you've got to take, number one, the consideration of flotation cost, which is going to raise that cost. But on the other hand, when you look at the tax rate and the return we get back from the interest expense, it lowers it. So you have to do those two separately. That is how you would look at debt. This is how you would look at preferred stock. So it's similar to a bond. You're going to have costs, right? You're going to adjust. Now there's no tax involved in this, correct? But we are going to have to adjust our preferred stock return with that flotation cost. And that looks like this. So this is the dividend, and this is the preferred stock. So now we have to get the preferred stock back to net proceeds. So let's look at this. We have a dividend of $4.25. This is the stock price, current price, minus a flotation cost of 1.375. So you do this calculation and divide this into the dividend, and you find out that the cost of that preferred stock, okay, cost of our stock to us is 7.44%. Now, we're going to look at common equity. And common equity is a little bit more challenging because I don't have a definite return, right? And I'm kind of guesstimating a lot of this. So, it's not fixed, that rate of return, and there's no stated coupon rate, and there's no dividend to be attached to this. Also, you've got two sources of equity. You've got retained earnings, and then you have new issues of stock. So, and there's no flotation cost on the retained earnings, but the firm usually gets costs. There are costs associated with that common stock when we put it out. Remember, we have to hire a brokerage firm. We have to do all types of things to. So there's a cost on that common stock that goes out, the new. So there are two methods. One is called the dividend growth, and one's called the CAP-M, which we've already discussed. So let's look at both of them. Here is the growth method. And that says, okay, you take dividends expected for 1 year, hence we're going to take the price of the common stock, right? And then we're going to add the growth to it. So you end up with an example like this. This is, hold on, I'm way ahead of myself. This is the retained earnings, okay? Now your new issues are going to be just a little bit different because we know the value of the retained earnings here. What we don't, and there's no cost associated with putting out the retained earnings. There's nothing to bring back to the net value. Whereas with new stocks, we do have to bring that back to the net proceeds. So, same calculation. The only difference is retained earnings does not have a net proceeds and doesn't have flotation cost, whereas stock does right here. So let's look at two examples. Company expects dividends this year to be $1.10 based on the fact the dollar were paid last year and they expect 10% growth, okay? And the stock is trading at $35 a share. So what does that give us here? So here is the stock. There's the stock there. This is our expected dividend. So we're going to divide that and add that growth to come up with 13.14% as cost of retained earnings. Now for a new stock, though, you've got to take into consideration that $3 flotation cost. So that's going to be $35 minus 3, and then the same whole procedure again, and you're going to find you have a higher cost for new stock because of the flotation cost. So that is the dividend growth method. And it assumes a lot of things which can be very dangerous. It assumes a constant growth, and we always have to forecast that growth rate, and that's a little bit iffy. So the CAPM is a little bit different. Okay, so you've got the risk-free rate right here, plus the beta. You multiply that times the market minus the risk-free rate. That's very slick, it's very easy, it's very simple. Most of those, in fact all of those, are pretty concrete numbers. Using that formula, okay, you've got a risk-free rate at 1.5 here, plus the beta here. You're going to take the market rate, subtract the risk-free, multiply everything out, and you'll come up with 12.125%. So CAPM, it's easy to apply. It's a little more concrete, and everything, risk-free rate is going to usually be your government securities, betas. You can calculate, but you can find them from a range of services, and this market risk premium can literally be estimated by looking at the stocks, the history returns, and the premiums over the risk-free rate. So all of those are very concrete numbers. A little bit better predictability. So what do you do with all this? Well, you're going to bring it all together and you're going to create the WACC, right? So you're going to look at the weighted average cost. So you'll take the after-tax cost of debt times the proportion of debt of the financing, plus the cost of equity times the proportion of equity financing. Here's an example. It makes a whole lot more sense. So we're going to say that the after-tax is 7% for money, and that the equity is 12%, equally divided. So 50% of the 7% plus 50% of the 12% gives us a cost of capital of 9.5%. Very easy to do, and if it were oh so easy as that in the business world, it gets a little more complex because there are different issues of debt that you have to look at, and you also have to look at preferred stock and common stock. Now this one example is just looking at common, and it's looking at one bond issue. But the idea is the same throughout. So if you have, let's say you have a bond issue, and you have preferred stock, and these are your retained earnings here. So you've got 35% in bonds, 5% in preferred stock, and 60% in the retained earnings of the common stock area. You'll just multiply those out. This is your after-tax cost of capital. And then you'll bring your weights in. So you've got, this is your capital, or your percents, 35% times 7, 5% times 13, and 60% times 16%. And you'll come up with a cost of capital of 12.7%. Now, if you've got some new issues of common stock here, 60%, you're going to have a little bit higher cost of capital, which you're going to have to factor in. So instead of having 12.7, you're going to have 13.9. So that kind of lays out how you would do this. You would find the amount raised, you would find the percent of the total, and then you would take what their after-tax cost of capital is and multiply that out in this. It takes a little bit of number crunching, but it works quite well. So that is WACC. I hope you've enjoyed this. It's a lot of fun to play with this. We're going to do one in our activity.